All right, good afternoon, investors and traders, and welcome back to our weekly State of the Market by Finom Group. And I am your host, as always, Seth Golden. And so I hope everybody's having a great trading week going into Memorial Day weekend. No trading. Markets are closed on Monday. And again, everybody be safe out there. But I do hope you enjoy the extended holiday weekend. So with that, let's get into it. The top 5 reasons we hear from investors for being or becoming bearish on equities are shown here. Inflation, supply line bottlenecks, asset price valuations, COVID-19 variants, and eventually the possibility of higher taxation. While those are all notable reasons, in my opinion, they're not really, I don't view them that way. I view them as there's one brick, there's another brick, there's another brick, another brick, another brick in the wall of worry that, investors sometimes create themselves because they're feeding too much or paying too much attention to the financial media headlines. Another way of looking at this, I tend to think of as investors planting trees, obstacles, if you will, in front of inevitably where the market is heading, which is higher prices over time. These may just provide temporary speed bumps, but if you heed too much warning into each of these individual bricks in the wall of worry, if you will, it can create a state of like rigor mortis in the whole of your trading and investing activities. So be careful with these narratives that the financial media likes to latch onto and disseminate, because they are always in search of a fearful narrative. And all of these seem valid, yet you could have had added bullet points all the way down here and going all the way back to the bottom in March 2020. I mean, some of these existed back then. COVID variants, asset price valuations, like everybody's been complaining about that for the last year as the market has rallied. Supply bottlenecks goes all the way back to the end of the year, and it filtered into this year with the Suez Canal blockage. Inflation, that's not a new narrative either. So these kind of just build on each other, and sometimes they'll get a new lifeline, if you will, and come back to the surface. But again, the market is a forward discounting mechanism of earnings. Like, do any of these really impact earnings in any significant or consequential manner? In my opinion, no. We've tackled the COVID-19 variants with higher prices, and we tackle asset price valuations in the sense that you don't make capital allocation decisions based on valuations. There's really no correlation between the S&P 500 and valuations. It doesn't exist. It's just something we've come to lean on as a bearish narrative, but it has no validity in what the S&P 500 does. Therefore, it shouldn't be your deciding factor on whether or not to buy, sell, or hold equities. Anyways, at the end of the day, here's the offset. Wake me up when these are bigger, when these issues become bigger than the $6.5 trillion fiscal stimulus already pumping through the economy and $120 billion worth of monthly Fed purchases. That combined with a year-over-year baseline economic comparison of basically zero, because that's what we're lapping right now, is an economic shutdown that started in, March, and it essentially ended in June. So we're still anniversarying like these zero prints in the economic data from one point of reference or another. Like, when these get bigger than this, okay, then you got something. In other words, if this becomes scalable, you've got something. And usually it takes a combination of these types of factors, scaled, to overcome something of this magnitude. So again, kind of just putting it into perspective. I get it. There's always going to be things to be concerned about. But it's going to take a whole lot to offset, this kind of fiscal stimulus and easy monetary policy, which, and I get it, this is not going to be forever. The Fed is going to taper at some point, and we'll get into that a little bit later. All right, many investors make the mistake of buying high and selling low, while the exact opposite is the right strategy to outperform over the long term. And I don't think this truism of investor success disregards or exonerates buying high and trying to sell even higher. But it does speak to risk reward. Usually you have a better risk reward if you're buying low and giving yourself enough duration to sell at a higher price. But when you are buying high and trying to sell higher, that's a different risk reward equation. The probabilities are lesser than if you buy low and sell high. So in the paradigm or practice of buying high and selling higher, we do have to presume the higher risk when compared to buying low and selling high. And why do we want to buy low or during corrective periods? Why? Some of you have seen this chart before. We monitor its progress on a quarterly basis because it's only updated every single quarter. And we'll get the Q1 stats at the end of June. And this is the S&P 500 total shares outstanding. And you can see how they diminish over time. This only goes back to 2007, but we get an increase in supply when you get these kind of economic events and global catastrophes, recessions, and strong bear markets, right? So as people are selling, it increases the supply of shares, and the demand kind of diminishes. But in general and over time, the supply just goes down over time. So I think of it like, if you guys remember the commercial, the Doritos commercial from the 90s with Jay Leno, and the catch slogan back then, snack all you want, we'll make more. It's the exact opposite when it comes to S&P 500 shares outstanding. It's the opposite. Snack all you want, we're not making more. Either it's through mergers and acquisitions or just general increase in demand for risk assets over time, the supply diminishes. So we essentially have an asset with diminishing supply and increasing demand on that supply as the asset increases in value over time. Like, that's the sweet spot. That's what you want. Maybe a metaphor to this, or looking at a different asset class, would be land, right? That's why I say real estate's always a good investment. We're not making any more land. It's just, that's not really possible. We're not making any more land. So you have an increase in demand on that supply of a diminishing supply. It's a good investment. It's the sweet spot. Land and just real estate in general is a long-term, strong investment. So do keep these principles in mind, when you rationalize the whole buy the dip paradigm. All right, let's get into our first study. This is from Steve Depp. And recall, we had talked about this back in April. April proved the 6th consecutive month where market participants collectively bid the price of the S&P 500 to levels we've never seen before, aka new all-time highs. Now, based on the data above, new highs do indeed usually promote more gains over the mid and longer term time frames. So this was back in April 2021. So the 1 month return, here we are in May, the 1 month return is not that great, less than 1%. And the percent higher probability is less than 50% of the time we're actually higher in the S&P 500 after you've had 6 consecutive months of all-time highs. We have made a new all-time high here in May, but essentially we've gone nowhere. We're trying to stay above 4,200 today on the S&P 500, having said that, but we've been stuck in this range. This leads us to contemplate what might happen in June. But having said all that, realize now that we've done it 7 months in a row, because in May, we've also hit a new all-time high. So really the question is, the questions are we going to be positive 2 months later, which is a much stronger return here? This study is really kind of playing out as we would expect. Marginal, average returns 1 month later, which is what we're getting here in the month of May, kind of, chopping around, doing a lot of time consolidation, but possibly leading to greater forward returns in the S&P 500 in June with a much higher 88% positivity rate. It lessens, 3 months out, 4 months out, gets even, starts to ramp up the probabilities of strong returns 6 months, 8 months, and 12 months later. But this speaks to the trend being your friend and gains begetting more gains during an uptrend. So do keep that in mind. And this is, essentially a look at what the market has done since April. Here we poked above 40.50, got all the way up to 42.38, and, checked back to 40.50 here just about twice, a little bit above 40.50 there twice, which proved support. And now we're getting back, above 4,200 today here, barely on the S&P. A high of the day today was 42.13, which is also the intra-week high that was set on Tuesday. So we'll see if we can hold on to 4,200. But in the grand scheme of things, this is your trading range, which is also a pretty, protracted consolidation period. The 50-day moving average was at 40.50, just 2 weeks ago, but with each passing week, it edges higher to where we have it now at 41.09. It's gaining a good 25 or so points pretty much every week in the S&P 500. The good news here also, recall, we frequently talked about the S&P 500 being overextended, two plus standard deviations above the 50-day moving average. And so, during this kind of consolidation period here, we've managed to work off a lot of these overextended conditions that were presented here by essentially going sideways through time, which is a lot better way to consolidate than a bigger price consolidation, a break through the 50-day moving average. And, from there, will the dip buyers come back in? So this is kind of the optimal consolidation, consolidating for time more so than price. Don't look a good time consolidation period in the mouth, so to speak. So we'll see what happens next year. Just because you buy a stock and it goes up does not mean you are right. Just because you buy a stock and it goes down does not mean you are wrong. Kind of a famous quote there from Peter Lynch. Essentially, like what can provide you with a gain is really what matters most, right? At the end of the day, we're investing and we're trading to make money, to deliver capital returns. So what can prove an investor right or wrong is often associated with the duration of that trade or investment. So what I would say is, as long as the fundamentals haven't changed for that trade thesis, just give it more time. Extend your time horizon if that's what the trade or investment demands. Duration or time is the investor's greatest asset. A lot of folks just don't use that asset to extrapolate its great value. Stay in the trade, stay in the investment so long as nothing has changed fundamentally. Technicals break down all the time, but there's usually a floor, a bottom for those technicals. What provides that floor? Essentially, the fundamentals. And this kind of reminds me of something that I had tweeted all the way back in May. The end of May 2020, where we were up like 15, 18% in the S&P 500 that time, coming off of the March low, the bear market low. Back then you had Buffett. No, I'm not buying. Druckenmiller, it's the worst value ever. Tepper, too rich for my blood. All the different analysts from JP Morgan, the market's going to consolidate. Morgan Stanley, Mike Wilson says it can consolidate. David Kostin of Goldman Sachs, the market can consolidate. We had U.S.-China tensions. It's the Wuhan virus. Are they going to live up to the trade treaty or the trade agreement? The 12-month PE ratio was getting hyperextended. We also had the march and riots around this time as well. And I wasn't kidding. I know this looks funny, yawning at these all these, famous investors and portfolio managers, hedge funds and analysts and strategists. But I don't really care what other human beings are saying and promoting and disseminating. What I care about is the data. What does the data tell me, beneath this sentimental commentary? That's what I cared about. And at that time, the data said, if we do consolidate, because there's no telling the future, even with the data, it doesn't give you a guarantee on the future. But all I cared about is if we do indeed dip, what does my cash position look like to take advantage of that? Because we thought that the bottom was in based on all of our technical analysis. Because that's really what you had to go on that point. Was technicals. Nobody knew what the earnings would look like. Nobody knew what the reopening of the economy would look like, the macro would look like. Therefore, you do rely on the technicals. And at that time, we saw washout levels that we had seen before in 2001/2002, as well as back in 87, 88. Our Williams percent R and the average trading range had both achieved their extended levels at nearly the same time. And usually when you get those two key metrics at their extremes at the same time, you have what's known as capitulation/deleveraging washout. From there, there's nothing left to sell. I mean, I'm generalizing. There's not enough to sell that will overcome the dip buying activity. We saw that show up in March. Those were the technicals that led us to believe the bottom was in. Now it's just about price action. If we get the dip, if we get the consolidation, good, fine, great. We can buy that dip. If we don't, we could chase the rip, but ideally we need a game plan of what we want to be buying at still what we believe to be good value. So Buffett, Tepper, and Druckenmiller, also you got to keep this in mind. These are multi-billionaires, okay? They can make mistakes. Something that Mark Cuban said in the past, a billionaire can make a lot of mistakes. In fact, when you're a multi-billionaire, you can do everything wrong. It won't put a dent in your portfolio. It won't put a dent in your reputation. It doesn't really change your lifestyle. Like, these people are not you. They have different considerations and different motivations. They're free speakers because, they've got a cushion there. It's cushions that we'd all like to have, but still, different motivations, different convictions. So keep that in mind. All right, now we've talked about this in the past before as well, but from a different chart perspective. This is basically the S&P 500 total return going back to 1925. What are the odds? Remember, time is your friend as an investor. What are your odds on any given year that the market's going to be higher? Well, going back to 1925, the odds are 73% of all years the market is higher. If you give yourself a 5-year time horizon, the odds are the market's higher 86% of the time. 10 years, 96% of the time. 15, 20, 25, 30. Essentially, just stay in the market. Always be invested. Give yourself time. With the benefit of index and sector ETFs nowadays, you got that additional advantage. Add to your 401k. If you're only doing 1% or 2% a year, we get a considerable dip. That's actually the time that you speak to your HR advisor or your benefits provider and talk to them about increasing your allocation. Give yourself time. The market stats are pretty eye-opening. In the moment, it's hard. You get a 5%, 10%, 15, 20% correction in the S&P. Our emotions kind of take over and we forget the probabilities. Time horizons are so critical when trading and investing. It can prove the most relevant factor in a portfolio's performance. The S&P 500 has fallen 2 weeks in a row. Are we going to be up this week? Well, the stats tell us that it has not fallen a third week in a row since mid-September last year. That's 8 months. It's 8 months. Week to date, the S&P 500 is up almost 1%. Living up to that so far. The probabilities are working out. We still have the end of today, and of course, we still have tomorrow. And tomorrow is, Friday, going into an extended holiday week with a key inflation data point. The PCE, Personal Income and Consumer Spending, and Core Inflation Gauge, which is the primary gauge utilized by the Federal Reserve to judge or assess one of their, dual mandates, which is price stability, i.e. inflation or deflation. And this is another chart just looking at, the probability of a negative return based on S&P 500 total returns from 1929 to present. As your time horizons grow, the equity losses fall off. If you just hold for a day, you have a pretty good probability, 50-50. You're either going to win or lose. As a day trader, it's almost 50-50, which is why day trading is not a great idea. You hold for a month, it starts to improve. You essentially have a 62% probability of achieving a gain and a 38% probability of losing. 1 quarter, you hold for a year. Again, this speaks to this right here. Only a 26% probability of a loss, 73+% probability of a gain for an index investor, so on and so on and so on. Give yourself time. All right, last couple trading days of the month, and then we're in June, folks. We're almost halfway through 2021. How are your portfolios doing? Do you have a plan, a mid-year plan? Do you reassess, reevaluate your portfolio? I suggest to investors that they do so on a monthly, if not a quarterly basis. So by the end of June, I would think that, a mid-year assessment of your portfolio, your trading plan, your successes, your wins, i.e. your opportunities, is reevaluated. Maybe you do have some course correcting, some adjustments to your plan, to your strategy, even your goals for the year. But these are the statistics so far as June's concerned. We are in a post-election year, so kind of, make sure we incorporate that value into the study. This comes to us from the Stock Traders Almanac and Jeffrey Hirsch. And in post-election years, the month of June, not so great for the Dow, S&P 500. NASDAQ has a greater probability of a gain, so does the Russell 2000. Up and down, 6 and 6, though. It's the 8th best month of the year, though, for the NASDAQ. It's one of the worst months for the Dow and the S&P 500, ranking number 11 and 10 out of course, 12 months. Again, critical component here is it is a post-election year. So we'll see. We'll see. Some good data points here. We haven't had a major correction yet. Maybe it shows up in June. Maybe it doesn't. The breadth is still very strong, folks. Breadth in the market is still very strong. New bull markets do historically build on year one gains in the second year. The average return is almost 17%, but you also have a pretty good correction. And we know that there's a host of strategists, analysts, portfolio managers out there that have consistently called for a 10, 15, even 20% correction. And yet the best we could do is basically on a closing basis about 4.5%. Peak to trough 5.8%, but that wasn't on a closing basis because we had an intraday reversal. And so only a 4.5% closing basis correction so far here through the first 5 months of the year. So we know the probabilities. We'll see if it shows up. But again, double-digit returns in year two after very strong. This one is with respect to a S&P 500 index performance following a 30% or greater bear market. That's the qualifier. And we did have a 35% decline last year. What also happens into the late spring, summer months, this is your VIX average daily close with your mean readings here at the bottom. And as you can see, although the S&P 500 is not expected to do relatively well in the month of June, here's June here. If we scroll all the way down, it's lighter green there. And you can see that the green shades have a lesser mean value on the VIX, which means we tend to expect lesser volatility in these months. So, for June and July, these tend to be your lesser volatility or VIX months of the year. It picks up again in August and into the fall/fourth quarter. We tend to get greater volatility. October being the most volatile month of the year. Keep in mind, this is another piece of, we talked about this particular VIX study just 2 weeks ago. When the VIX spikes greater than 40% in 2 days, which is actually spiked more than 50%, back, I think it was March 12, 13, 14, mid-month. And this is what that study offers. After that 2-day spike in the VIX, the average S&P 500 return is 2.13% 1 month later. 3 months, 6 months, look at that. 6%, 10%. So 1 month later, which is our, by June, mid-June, and percent positive or win rate is 75% of the time. So do keep this in mind. You don't want to dismiss these references from the quantitative side of data. Here's another one. We started May with selling. The first 2 weeks of May, we basically started with selling pressure. When participants do indeed sell in May and go away to this degree, someone's trash has been another's treasure. Again, this is from Steve Depp. And the first, 3 days in a row. Here are all 3-day losing streaks that decline 3% or worse in the month of May since 1980. 1-day return, 10-day return. You see a lot of white here. So positive returns, 20 days, because this happened both at the very beginning of May and mid-May. So 20 days later, 3.3% higher. 72% hit rate, which takes us to the end of this month if we're using the beginning of the month. So far, so good. Again, can we stay above 4,200 today? Remains to be seen. All right, so here's another study that basically focuses on the fact that we've completed 100 trading days this year as of yesterday. We've completed 100 trading days. This comes to us by LPL Research. If the S&P 500 index is up greater than 10%, which we are, we're up 11%, year to date on day 100, the bulls usually smile. So we were up 11.7% as of the 100th trading day of the year. The returns for the rest of the year are an average of 8.6%, median 9.3%. The percent positive rate, or the win rate, 84.2% of the time. I like that. It doesn't speak to drawdowns, I get it, but that's okay. Use those drawdowns. This kind of data tells you what to do with those drawdowns. It speaks to the breadth in the market, how strong it has been so far this year. Do you see 2010 on here? Because I know we've often talked about the 2009, 2010 analog. That's not on here because we started that dip. We weren't up going into May. We were not up, 10%. And we had that good 16% correction basically into July before we started the upswing again and made new post-financial crisis highs. But we were not up 10% in 2010 on day 100. A kind of a differentiator here, which again speaks to the difference in breadth this time versus 2010. And, just looking at the chart right here, the stocks, percent of stocks trading above their 200-day moving average is still near 90% of S&P 500 stocks trading above their 200-day moving average. We did not have this in 2010. So again, keep these studies in mind, refer to them at your leisure. All right, and again, I spoke to breadth just now here using this particular breadth indicator, and of course we have to rationalize it against the advanced decline line for the S&P 500, which has actually been a little bit stronger than the S&P 500 itself. The S&P 500 is the dark shaded line, and the cumulative advanced decline line is above it. So breadth is actually better than price right now. What do we know about breadth? Well, breadth leads price. All righty then. Some performance ratios that we talked about recently, because we know that the whole investing style factor and rotations, that whole paradigm is really front and center. It's kind of taking or occupying the minds of most investors. And what we know is that consumer discretionary stocks, and that ETF has performed awfully over the last month. And this is basically a chart that identifies how bad. We haven't seen when we compare or use the relative performance ratio of the consumer discretionary ETF, ticker symbol XLY, versus the S&P 500 index ETF, ticker symbol SPY. When we use that relative performance ratio, it has never been this bad since 2009. And you can see it better on this chart right here, which is a 1-year chart of the XLY to S&P 500 ETF. All right, all the way, basically a double bottom here, right? Well, maybe. We'll find out in the future before it turned higher. And the problem here is you got 3 stocks in this ETF, Tesla, Amazon, Home Depot, that make up some 50+%. We know what happened after Home Depot's earnings. It had a really nasty pullback. Amazon's done nothing but go sideways for the last 9 months. Tesla's been in a downtrend here now for the last 2 months or so. Dropped below 700 after earnings, dropped below 600 recently. And these 3 stocks working against the ETF and have basically put in, this was not a good place to be in consumer discretionary lately. But is this a new bottom? Just remains to be seen. It's had a nice bounce here, but it's got a lot of work to put in, a lot of work. Another relative performance ratio that we've been highlighting and focusing in on lately is also the tech sector ETF versus the financial sector ETF, because as we know, technology sectors and stocks have been underperforming financials, right? And you can attach any narrative you want to it, because the financial media seems to have at least three narratives. It's inflation, rising inflation, and therefore technology stocks tend to underperform during rising inflation, which is not true. If you go back to 1998, 1999, what did the NASDAQ do? What did technology do? And that's in a year where inflation basically doubled. You also had the 10-year yield move up 200 basis points. So no, it's garbage. It's not true. The other narrative is, well, technology stocks are duration products, meaning that their free cash flow and earnings power tends to be out in the future, not as much near term in a rising inflation environment. Also, completely false. Completely false. If you add up, take the value ETF, right? Because value is outperforming growth. What is growth? Well, it's technology, right? Communication services also. Add up all the individual components in the growth ETF, or ticker symbol IVE. Go look at the holdings, add them up. Oh, add up the 5-year free cash flow model, because that's what we're talking about in terms of technology being long duration asset. The free cash flow and the earnings tend to be further out in the future than the value stocks. But if you add up the value stocks and then compare it to the tickers within, or the holdings within the technology sector ETF, over the last 5 years, if you add up their free cash flow back into the technology, both Facebook and Google, because they used to be in there until in 2014, we got this communication services sector ETF. So you add up the tickers in XLK, back into it, Facebook and Google, and now compare that with IVE. Which one do you think has greater free cash flow over the last 5 years? That's right. It's XLK. Like, none of the narratives that the financial media has been purporting over the last several months, if not quarters, have any foundational facts. They're creating this self-fulfilling prophecy whereby fund managers and individual investors have fed into it. So it's becoming this self-fulfilling prophecy, but it's not rooted in facts. They're not there. And I've tried every which way to validate the arguments being pushed into by the financial media. You've seen us do it here at Finom Group in our weekly State of the Markets, in our research reports. They don't exist. They just don't exist. Nonetheless, XLK has been underperforming XLF, which is why you have this downtrend here. It recently found itself yet another double bottom, possibly like that in this particular relative performance ratio. But it's starting to roll over again. We'll see. We'll see how this fares going forward. All right, so next week is the Memorial Day trading week. It's only a 4-day trading week because there's no trading on Monday. So we wanted to look at some of the historical data to better understand what we might expect. This goes back to 1971. Let's see. Officially became the last Monday of May, and since then it has been bullish week for stocks, with the S&P 500 averaging a gain of 0.52%. As you can see here, Memorial Day since 1971, 0.52%. If you take any other week, this is a much better return. This is a much better week for the S&P 500. Having said that, the upcoming week has been dreadfully bearish since 2010. The index has actually lost an average of 0.60% during the week of Memorial Day since 2010. So it has not been as good. Will that, trend break this year? Remains to be seen. So that's what this panel is over here. Since 2010, Memorial Day week, average return down 0.6%. over the last 11 years. Any other week since 2010, you have a positive return, except for Memorial Day week. We'll see. S&P 500 Memorial Day week since 1971, so 50 years. In the table above, we identify how the S&P 500 has performed each day from the Friday before Memorial Day, so tomorrow, to the end of the holiday week. So from Friday to the following Friday in Memorial Day week. Friday before Memorial Day, over the last 50 years, the average return, negligible. Tuesday, next week, gets better. Ain't nothing happening on Wednesday next week. Thursday, Friday. And this is nothing really to write home about, right? The gains are negligible on the whole. All right, so above is similar data, but only since 2010, since we started with, separating it out. Let's also just look at 2010 from the same perspective. Friday before Memorial Day is negative, negligible. Tuesday, negative but negligible. Gets better on Wednesday and Thursday. Friday's pretty rough. That's where it all comes down to next Friday, if we're just looking at it from 2010 to 2020, last year. So we'll find out one way or another next week how this all plays out. Now, good news. Okay, so this could be bad based on recent trend next week, but there is a bright side to things. The S&P 500 is up significantly on the year, which has been a good omen for stocks the rest of the year. When the index was positive through Memorial Day, which it will be unless we lose 11.7%, because that's basically how much we're up year to date. So when the index was positive through Memorial Day, it averaged a 5.82% gain over the rest of the year with a nearly 74% positive return rate. We like that. So 1 week, like, who cares, right? That's just a very narrow prism. The bigger picture is where we're going into the Memorial Day week with substantial gains. We tend to tack on more gains in the remainder of the year. Okay, so at the top of our SOTM, State of the Market, we talked about valuations because that's a concern everybody has. But again, if you look at the data, this is the chart right here, the S&P 500, 1 year price performance juxtaposed with all the different degrees of price to earnings multiples being above 25 to all the way down to maybe, 5, 6 PE. The correlation is negative, meaning there's no correlation. That's why I say you should not let valuations guide your capital allocation decision making. Another way to look at it here, if people really want to, believe in this whole narrative about valuations and focus on it, this is from Charlie Bilello. The lowest decile of interest rates, which is 0.6 to 2.4%, has a median CAPE ratio of 21. That's the median CAPE ratio, which is not materially higher than the median for all deciles. They're mostly around this level. You got this outlier right here. And look at that right there. Look at the interest rates right there. So really, valuations aren't even tied to interest rates because that's another big narrative. The lower interest rates are, you deserve a higher PE ratio. But historically, that is not what the data tells us. It's not there. Going all the way back to 1881. Interest rates do not necessarily justify a higher PE or a lower PE. People just like to look for, we're humans. We like to categorize things. And we look for causation. We want to know the whys. When we see things that tend to lean toward a bias that we've already developed, we tend to think that's the fact and run with it. The reality is it's far from it. These are all over the place. So even interest rates are not the reason the rationale why valuation should be up, down, in the middle. It just doesn't work that way. I talked about free cash flow because no matter where you go, you hear this. Technology stocks are long duration assets. Therefore, they tend to do poorly, which is not true. There's no historical, data supporting that technology stocks or the NASDAQ or growth stocks do worse in rising inflation and rising yield environments. That's the narrative because they're duration. What does that mean? Duration. It basically suggests that technology stocks take a longer period of time to generate free cash flow, which essentially correlates to earnings growth or realized earnings. And so here's a chart or a table of 3-year free cash flow for the top cash flow providers in the indexes. Amazon, is that a value? Is that in the value ETF? No. Verizon is, Coca-Cola is, Intel is, Home Depot is. Those are all in the value ETF. You know where else Intel is? In the technology ETF. You know where Amazon is? And look at the disparity between Amazon and everything else. That is a lot of free cash flow within the S&P 500, let alone NASDAQ. Growth. Verizon is in the communication sector ETF, but way to go, value ETF, by stripping that one and adding it to your sector as well, your ETF as well. Again, saying the same thing with Intel. Intel's in the technology ETF. The value ETF decided, and we'll put that in here also. But these are essentially this is a technology company. Where's Broadcom? That's in the technology sector ETF. 28% of free cash flow for the S&P 500 comes out of Broadcom, comes out of Amazon. These are growth names. Look at Alphabet. That's not in the value sector ETF or the value ETF. AbbVie is not. Where's Apple on this list, right? That's probably your question. Where's Apple on this list? Well, here's the thing with Apple. During calendar year 2015, so if we do go back 5 years, if we're to look at this at a 5-year free cash flow generating model, Apple had the highest free cash flow at $63.37 billion among all S&P 500 companies. So on a 5-year basis, this would have been in here, which is a technology stock. It's not a value stock. That's much higher than the company's 52 or 53 billion in free cash flow in 2017. So this was like an outlier year at $63 billion in free cash flow. So it explains why the company's 5-year average is only 4.8%. But if you look at Apple's 3-year, so if we were to, strip out this anomaly, we would basically get to 14.9% free cash flow in the technology sector ETF. Very few companies even have, a 2% free cash flow rate. But this also illustrates the importance of seeing the data for each year, as opposed to just looking at a 3-year or even a 5-year. You kind of have to know the nuances. But again, I hearken back to, look at how much Amazon contributes. Look at how much at 14.9% Apple contributes. Look at how much Alphabet contributes. Broadcom contributes. These are growth. These are technology names. But the argument has been this area of the market, they're long duration free cash flow business models, earnings growers. That's not the reality. It's right there in black and white. Do you not want to be owning Amazon with growing 59.3% 3-year cash flow? No wonder the earnings results just, I mean, they double estimates. It's ridiculous. But people are not buying these stocks right now. That's why I say the media is just fulfilling, offering this self-fulfilling prophecy. When you look under the surface, none of the media's narratives are reality. Now, here's another reason why you could, like people say, inflation affects or is negatively impacting information technology sector. The reality is, no, it's not. Inflation impacts everything. We tend to have this, when we hear the word impact and inflation, we have a negative context or a negative connotation. Sorry, wrong word. We think of it negatively. Well, inflation negatively, impacts information technology. The reality is none of these have a negative impact from inflation. It's about relative performance against inflation. So inflation has a more positive impact on real estate or a correlation to real estate. Inflation has a greater correlation to banks, roads and rail, oil and gas, communications equipment, hardware, aerospace and defense, power renewables. I don't have to go down the whole thing, but you can see how low information technology shows up when it comes to correlation with CPI. It's not a negative correlation. It's not a negative impact. It just has lesser advantage, I guess you could say, when it comes to CPI, inflation. And so I often ask myself, why are we selling these stocks? If everything benefits, which is why I've asked it in the past, why do people look at inflation as if it's a bad thing for stocks? Do you think that the only thing that won't go up in an inflationary environment are equities? And this chart basically shows you that, yes, we should expect higher prices in equities also. It's just that we have less of a correlation with automobiles and information technology services, hence the technology sector. All right, so we're getting into the summer, June. We've got the next FOMC meeting coming up shortly in June. Is the Fed going to talk about, tapering and, that whole conversation is really going to start to heat up. Why? Because that's it. It's June. You don't have another FOMC meeting in July. And the next really get together, if you will, for the Fed is at Jackson Hole in August, the Jackson Hole Summit or Symposium. And so, as I've said before, I think this is where the Fed starts to really formulate a plan for tapering. I don't think the tapering will take place in 2021, but I think we'll start getting the message from the Fed that, if some of these inflationary data points are sustained into 2022, we'll begin tapering at that point. So we'll get that message well in advance, as the Fed has basically promised, before they actually taper. So again, it makes us, or helps us to, look back in time so far as what happened in 2013, the so-called taper tantrum back then. And we remember from that time period where, the Fed Chair Bernanke, basically made these comments at a congressional hearing about a potential tapering of bond purchases. People call it the taper tantrum, and a lot of investors believe that the Fed started tapering in 2013, which is anything but the truth. The Fed did not taper whatsoever in 2013, keeping in mind also the return for the S&P 500 in 2013 was greater than 32%. But we did see yields travel higher and inflation travel higher as well. The chart above, so this chart right here, shows how the 10-year Treasury traded in 2013, which is the solid red line, the left axis. Here was the tapering comments, which happened basically in May where we are now. So May 22nd is the highlighted box right here. And you can see the verbiage. Was the date of then Fed Chair Bernanke's ill-judged comments at a congressional hearing about potential tapering of bond purchases. As you can see, from that point forward, yields rose. Right? And what we're being told is technology and growth stocks are supposed to underperform when yields are rising. Inflation is rising. So now let's compare the S&P 500 sector performance for the pre-taper tantrum part of 2013, January up to that May point, where Bernanke made those comments of potential tapering in the future, and see how it compares to the tantrum itself, the taper tantrum itself. The S&P 500 has mixed up its sectors since then, so keep in mind that Google and Facebook were in technology then, and Disney and Netflix were in the consumer discretionary back then, but they're not anymore. Also, real estate was still in financials back in 2013. So pre-tantrum, up to the day of Bernanke's testimony, healthcare up 23%, financials 22%, consumer discretionary, staples were even nicely higher. If yields are rising, why are staples doing well? Like that's another, oh, well, they got to compete with, staples should underperform because they're competing with higher yields and the dividend. That didn't work back then. When you back test some of the stuff the financial media, purports, it just doesn't pass the sniff test. Industrials, the S&P 500 itself was up 17% into May. Energy sector, see, these are some of the lower or underperforming sectors. Energy, utilities, technology was the second worst performer up to that point, and materials. Now, here are the sectors that continue to outperform over the balance of 2013. So even after industrials, consumer discretionary, healthcare, they're all up here. They were outperforming. They still outperformed, or they continued with their outperformance. There are sectors that went from underperforming, these were underperforming, pre-tantrum, to outperforming, or post-tantrum. Look at that, materials and technology. So technology went up another 11% and greater than some of what we see here. Here are the sectors that went from outperformers pre-tantrum to underperformers. Financials, energy, consumers. Financials were doing great. They became underperformers. That's what yields rising through this period and into the end of the year. Again, like why, if yields are, rising, if inflation is right, because inflation was rising back then as well. Here we are in 2013. In fact, from February to April, CPI was actually going down on an annualized basis. And yet, technology was underperforming. It still was up 11%, but was underperforming with lower inflation. When inflation was rising through the end of the year, almost nonstop, technology became an outperformer. So what is the media talking about now, when the history tells us exactly the opposite? It's frustrating. All right, beyond that, we might have the Olympics. I don't know, maybe, possibly, perhaps. I mean, it's scheduled, but there's a lot of folks calling for, them to cancel it again. So here's some data around, the Olympics. 2 weeks prior to the opening ceremony, usually the market's down, and this is going back to 1948. Opening ceremony to closing ceremony, however, markets are usually higher. Closing ceremony, 2 weeks later, markets are usually down. And the long-term average versus the 2-week performance is up. So pretty good stuff there. I wanted to catch up on some, of the analyst community, maybe that we haven't mentioned, like Wells Fargo. So there's a lot of notes in here from Wells Fargo I think you should take advantage of for our members. With that, we'll see how the end of this week goes. We got PCE, more inflation data tomorrow. Ahead of that inflation data, we seem to have the bond yields rising again off of their best levels. We had the 10-year up 5 basis points at its high today. By the way, yesterday, it was down more than 5 basis points, back and forth. We've gone nowhere in the S&P 500. We've gone nowhere in the 10-year yield for basically since April. Both of those markets seem to be range bound. Is tomorrow's PCE data going to be, that line in the sand that essentially pushes one of these markets, over the edge? We'll find out. Breaks them out of these ranges. We'll find out tomorrow. With that being said, everybody have a great end of the trading week. Enjoy your Memorial Day extended weekend, and we'll see you again here next week.